So in the past hour, the US Federal Reserve has said it's going to spend $40 billion a month on bond purchases to boost the weak US economy. It hasn't even set an end date for that programme. The Fed says the economy is presently too weak to cut high unemployment and that it will keep buying the securities until the job market shows substantial improvement. The Fed's also extending a plan to keep short-term interest rates at record low levels through till mid-2015. Martin Koehring is from the Economist Intelligence Unit. Martin, good evening to you. $40 billion a month, apparently for perpetuity, or at least until things improve. This is a big commitment.
Yes, the reason for this, again, this massive quantitative easing to ease the economic slowdown is because recently the economic data in the US has been abysmal. I mean, employment growth has slowed significantly. I mean, the latest employment report shows that less than 100,000 jobs were created in August. And if we compare that to the beginning of the year, when more than 200,000 jobs were created per month. So that's a massive slowdown, and employment is a key factor, of course, for growth in the US. It's a very domestic demand-led economy. And also the oil price has been rising since June, also eroding household disposable incomes. So there's a clear economic slowdown in the US. And fiscal policy currently, so the government's measures, are not supporting growth as much. So the central bank has to step in to ease the slowdown.
And Martin, here's the problem, though, that the Federal Reserve will face, just as the Bank of England has. You can pump this money in, but how do you guarantee it actually helps the economy?
Yes, exactly. I mean, the confidence in the banking sector is still very low, and you know, we have still a lot of banks reluctant to lend to households and to companies. So that's the key. The money is actually not flowing into the economy. But nonetheless, we think that this measure will have a positive impact on on growth in the second half of the year, but not as much as the Fed thinks. But we shouldn't forget that at the end of this year, there's the fiscal cliff. So the risk that if the new government, whoever will be the next president, will not be able to cooperate successfully with Congress to make sure that there's that the spending the spending arrangements and the tax measures that were in place to stimulate the economy previously are extended or not extended. So if the fiscal cliff occurs, so if tax cuts are removed and if spending is reduced, then there could be a massive economic contraction in the US next year. So these measures by the Fed might ease that if the politicians don't come to an agreement.
Of course, the Republican Party won't like this at all.
Yes, exactly. I mean, the election is coming up in November, and they will accuse the Fed of interfering in politics, because you know, as things stand, the economy is the major topic in the upcoming election, and the economy is slowing and doing really badly, as we know from the employment data. So these measures will make it easier for President Obama to get re-elected, because the economy remains the main topic. It remains the #1 topic for the election.
OK, Martin Koehring, thank you very much indeed. As ever in America, it is the economy, stupid. Now.